Are you a real estate investor and you're wondering how do you pay yourself out of your limited liability company? Well, in this video, I'm going to break that down for you and show you how to take money out of your LLC and make sure you're doing it the right way so you don't increase your taxes. All right, let's get started. Okay, so when it comes to paying yourself out of an LLC, which is a common question, I'm asked this question so often in the comments on my YouTube channel, at my live events. People will come up to me and wonder, hey, how do I take money out of the LLC? And I always give them the answer, it depends. And I know people think that's the common attorney answer, and they're saying, well, I just want some clarity here. Well, the thing is that it's hard to answer that question unless we have some information. And so what I'm going to be walking you through now is the various types of structures and how you can pull money out of an LLC. And it's really dependent on how the money is earned inside of the limited liability company, meaning what type of activity is taking place in that LLC. So once we figure that out, then the answer becomes relatively easy on figuring out how to get money out. Okay, so what are we referring to here? Let's assume that I have a limited liability company. Here's my LLC right here, and it owns a piece of property. Now, for purposes of this example, I'm not going to bring in the holding company and show you how that works, because if I were to do that, I'm afraid it might confuse. I just want you to think about it in terms of how you're going to take money out of here. So if this LLC owns a rental property, and the rental income is paid into the LLC, so I am a member of my limited liability company. Now, because this LLC is engaged in what we refer to as a passive activity, okay? Passive activity, that is rental real estate. When the money's earned by the LLC is a flow-through entity. So what that means is that any income generated by that LLC, regardless if you take it out or not, the income will be taxed to you. Now, of course, you do have all your deductions you can use to offset that from that property, but it flows down to you and it's going to hit your 1040. Doesn't matter if you take the income out or not. Okay, that's how these things work, because when we're setting up an LLC for rental income for long-term hold property, short-term rentals are long-term holds, then the income that flows into it that is considered to be passive, that's going to come out to us, we're typically going to like to treat this as a disregarded entity, okay, or it's going to be a partnership, or it's going to flow through a partnership holding company. Okay, so anyways, whatever that decision is, okay, and how it's set up, the fact of the matter is, with this type of structure, the way you take money out of this LLC, number one, is going to be a distribution. So what is a distribution? A distribution is where the company distributes the profits or the cash to its members. That is referred to as a distribution. Now, let's just say I'm a manager of this LLC as well. Okay, I'm not going to want to pay myself as a manager of the LLC because that would be active income. And so I'm taking what is passive and I'm turning it into active if I pay myself as managing this company as an individual, and then it's going to be subject to employment taxes. So you see how you can take what is passive and very easily screw this up and turn it into active if you're stating, well, I'm going to pay myself a management fee. We don't want to do that. With passive activities like this, you want to take the money out as a distribution. That keeps you at the lowest tax rate as possible on this income. Now, another way in which you can take out these funds is as a loan. Okay, so what that means is that the LLC agrees to loan me the money. Now, in a loan situation, okay, there's not a lot of benefit in this scenario when you take the money out as a loan. And the reason I say that is that you're still taxed on the income. So if you're taking the money out as a loan, I really don't see where it's getting you, what it's doing for you in that scenario. So oftentimes I just tell people, hey, don't bother with this, just take a distribution, which then belies the question, how do I take a distribution out of my LLC? Well, it's really simple. I assume you have a bank account because you've been depositing money into it. So in order to take out a distribution, you just write a check, okay? That's all you got to do. Or you do what I do is I jump onto my app and I move money from my LLC to myself. Now, I did talk about having a holding company here, so I think I need to touch on this as well. Okay, so If you've set up a Wyoming LLC as your holding company, you're trying to figure out how to take money out of this structure. So what it looks like is going to be something like this. Here's my Wyoming LLC right here. And this LLC is owned by that. And then I'm down here and I own the Wyoming LLC. You're still taking distributions. Now the distributions run as follows. The distribution will go from here to here. Okay, that's the first distribution. The second distribution will go from here to here. Okay, 2 distributions. So now you've taken it out all the way down through that Wyoming LLC. So you have a bank account right here, we have a bank account down here, and then we ultimately have our own personal account, which we pull those funds out. So that's how you would take it out, and you would classify each of those as a distribution. Now, another scenario that we're going to look at then is what happens if the income is not from this type of activity, from a passive activity. It's generated from an active type of business, such as flipping or wholesaling. Okay, so in that case, what you'll do is you'll have your company. Here's my LLC, and it's treated either as a C or S Corp for federal tax purposes. So in the last example, that entity was a disregarded or a partnership. Now, when you're flipping or you're wholesaling, the issue is the type of income that's generating. It's generating active income. So now we have to then look at ways to reduce that overall income to ourselves, the taxation on that. So in this scenario, let's assume that my company is set up as an S corporation. So with the S corporation, what I'm going to be doing is I will put myself on payroll. Okay, so if I'm dealing with the S corp here, I'm going to put myself on payroll, and let's assume that I've generated $100,000 in earnings from flipping and wholesaling. So what am I going to do with that money to take it out to myself? Well, I'm going to pay part of this as payroll. So let's say I take out $30,000 as payroll. So I'm on a salary there. So that money comes out to me as salary. When I take that money out as salary, it's subject to income taxes, and it's going to be subject to employment taxes. Okay, we'll just put ET, employment taxes, at 15.3%. So this is why I didn't pull out the full $100,000 as salary, because if I did that, then I'm going to have $100,000 subject to 15.3%. Now, I do want to caution you on one thing here. I know a lot of people that post videos on YouTube about S corporations saving on employment taxes, pulling the money out as a distribution, don't taking out as salary. They talk specifically about this savings right here. Hey, you take $30K out as salary, you take $70,000 out as a distribution, just like we did on the other one. You take out a distribution, which is essentially writing yourself a check and calling it a distribution. You don't have to pay the employment taxes on that distribution from an active business that's treated as an S corporation. What many of those individuals, in my opinion, fail to realize is that there are certain scenarios where having more salary is more beneficial, meaning when you're looking to qualify for loans and you're working with lenders, hey, it's not always about saving on taxes. It's about looking good to a lender, looking good, in the underwriting process. So maybe you want to show more salary in order to make it easier to qualify for loans on the investing side. So that's a balance you have to weave when you're putting together your structure and determining what is the best way to pull money out. But on the active business side, the first way you would do this, if it's an S corporation, is a combination of payroll and a combination of distributions. Those are the two things that we're going to be using there. Now, if you're not doing this and you've set it up as a C corporation for federal tax purposes, so let me just get rid of this. Now, with the C corporation, the way you're going to pull money out, it's like the S corporation. You're also going to pay out a salary to yourself. All right, so now we'll pull out $30,000, let's say, as our salary. That's subject to employment taxes. But when I take money out here and I distribute it to myself, because it's a C corporation, this is called a dividend when it comes out to us. Now, this is where many CPAs and tax professionals will say, hey, double taxation, news alert here. When you pull money out of an entity that's treated as a C corp, you're going to pay double taxes. That's true. That is accurate information. You'll be taxed once at the corporate level on those funds. So if I had $70K inside of here after my $30,000 salary, which is a deduction, that $70,000 would be subject to taxes at 21%. And then the remaining money, which would be about $56,000, that $56,000, when it's paid out to me, would be taxed at 20%. So there's the double taxation. Okay, now, for a lot of business owners, investors, okay, paying the dividend out, if you're in the highest marginal tax bracket, well, it's going to be pretty equivalent to taking the money directly through an S corporation, meaning you're not going to be paying that much more in taxes. So this is where you need to look at a different strategy possibly, meaning that rather than pay a dividend out of your company, why not do this? Have the income taxed at the lower corporate tax bracket of 21%, and then you have that $56,000 left over, and then take the money out as a loan. So this is the one instance where taking money out of your company, not as a distribution, not as a salary, but taking it out as a loan makes a lot of sense. Because when that money comes out to you as a loan, loans are not taxed. So what you did is you took advantage of that lower tax rate of the C corporation to tax your income, and then you borrowed the money back out so it's not taxable to you in your higher personal income tax rate. So those are three ways. Now, one other way in which you may take money out of your active business is through a reimbursement. Okay, so what is a reimbursement, and when are you going to be looking at something like that? And you're probably looking at this saying, I can't read his writing. Okay, that is reimbursement right there. So a reimbursement is generally going to be taken when you've expended money on behalf of this company. So let's say that I was taking some real estate training courses to learn how to become a wholesaler or how to flip real estate. And I made an investment of $18,000 to take these courses. Well, in that case, what I want to do is I want to make sure that I'm able to get all that money back from my business before I start paying taxes on any money. So as my company makes money here, let me just clean this up a little bit. So as this company's making money, let's say the first $18,000 that come into my corporation, then I'm going to choose to use those funds to reimburse myself that $18K. So I made $18K in my business. I'm reimbursing myself $18,000 so my business has zero profit because I spent those funds for the benefit of my business, so it's reimbursing me. If you wrote that up as a salary, then it would have been taxable. So this is one way to pull money out of your business where you make it non-taxable. So if I've spent money on behalf of my business, then my business will reimburse me for those funds. And I see a lot of people miss this. New business owners who've created entities that are getting involved in real estate investing, if they're on the active side, they forget about this potential reimbursement strategy to, hey, let's pull that money out, those profits initially, get them out of the company and not have to pay any tax on them. Now, the one last thing I want to leave with you here on this strategy is, again, if you've got the active side right here and then you're also looking to buy property over here, that reimbursement strategy, you have to use it wisely, meaning this, that when I talk to someone here, when we're working with an investor that has set up some entities with us and we're discussing, do we take a reimbursement, do we take a salary? One of the questions I'm going to ask you is, hey, are you going to look to qualify for conventional financing outside of the active side of your business? Meaning, are you trying to buy a personal residence? Are you trying to build a rental real estate portfolio? If the answer is yes, then taking a reimbursement does not help you per se with your investing because that reimbursement is not considered income. And as you know, if you're trying to qualify for financing, the more income you have, the better you look to the underwriter. So maybe there's a strategy where you hold off on the reimbursement, take it out as salary to get a higher income, and then come back to the reimbursement at a later date. I know it can get complex, but that's the thing about working with a firm such as Anderson, where we look at it from more than just the tax planning standpoint or the asset protection standpoint in putting together plans. And there's a lot of companies out there, they understand one or the other, or maybe a little bit of both, but they don't understand there's a business side to planning. And that business side is helping you grow your investing business and making sure that your entities help you achieve that goal rather than hurting you. And if you want to learn how entities can help you with your investing, go into the show notes. I have a link in there where you can set up your free 45-minute strategy session with someone here at Anderson, and we will analyze this for you and help you design out a plan. It's completely free. Take advantage of it right now. Take care.